Good morning and welcome this morning to Trader Talks in Today's Market. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I am joined by a couple of great folks that you're going to want to know. First of all, I'm joined today in the conversation by my good friend Brett Crowther, also a senior manager here at Charles Schwab. You probably know him as a 20-plus year veteran in the financial markets. And he is also a frequent contributor on the Schwab Network, which is brought to us by our separate but affiliated media production company, Charles Schwab Media Productions. I'm glad to have Brett on board today. We're going to meet Brett a little bit more here as we get into the discussion. But you've also got Mike Fairborn out there in the chat. Mike is also a 20-plus year veteran in the financial markets. He's going to be there to help answer your questions. And of course, we are all joined by all of you that are here with us live. We're glad to have you here. If you're watching us in the recorded version, thank you for joining us as well. Make sure that you are a part of the conversation. Mike's there to help manage the chat. He's going to be there to help answer your questions. And if you're in the recorded version, leave us a comment in the comment section, and we will reply to that as quickly as we can. So, Brett, a couple of quick housekeeping items we need to take care of as we get started here this morning before we get into the conversation. Remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy or idea or account type or anything else. Now, we're likely not to talk a lot about options today. However, if we do talk about options, or if you are trading or considering trading options content, remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transactions. Now, we're going to be using the thinkorswim desktop software platform today, specifically the paperMoney version of that platform. Remember that it is a great learning environment, great place to practice. It is not a guarantee of future success out there in the real world. We're going to be using a lot of technical analysis today, as well as a lot of discussion about what's going on in the market. But remember that Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Investing involves risk, including the loss of principal. Brett, I don't know if you've ever heard that before, but that is an important consideration, that there is risk out there in the market. Yes?
Well, once or twice. There is risk out there. I mean, it should go without saying, right? But we still need to say it. But it is good to be with you, Ben.
Yeah, we haven't been together on a webcast or in a broadcast like this in quite some time, so I'm glad to have you with us. And as we take a look at the market here, I just want to say thank you. I noticed a number of people chiming in that they were in the most recent live workshop that we did, which was in Schaumburg, Illinois, just outside of Chicago, over this last weekend. Thanks to all of you that were there and who are now joining us today here in this webcast. Kevin Horner, who normally hosts this webcast, was there as well. I'm just filling in for him today. Brett, hey, it's always a good time to remind people as we jump over here to the thinkorswim platform that it's a good opportunity to click on that subscribe button down at the bottom of the page, so that we make sure that everybody gets to be a part of the larger community of Trader Talks viewers and participants. So we're glad to have you do that. Click on that subscribe button. It's at no cost to you, and it helps us out, helps you out too. But Brett, let's get started with the SPX today. The indexes were down just a little bit on the futures market this morning, but as the opening bell just sounded before we started, now starting to move a little bit higher here on the broad market, yeah?
Yeah, starting to poke its way up, and it's still early in the day, and so it's not going to tell us anything in the end, right? However, Ben, it's been a good run. I mean, it's been climbing for quite a while, even though Friday was a bit of a down day. Most of last week, it was still an up week last week. And so there's still been a lot of bullish pressure on most of the major indices across the board. Maybe the SPX not being the strongest, but there still is that bullish pressure that we've seen as kind of where are the trade winds going.
Yeah, for sure. Now, the one thing that I noticed, and I want your idea on this as well, because I know you are a really good market technician, is I'm noticing that on the RSI, the Relative Strength Index, which is a sentiment gauge, it's kind of a gauge of overall the momentum behind the move, that if we look back into late July, the last time we were up near, at that time, new all-time highs on the SPX, the RSI was a little bit higher. There was a little bit more extreme momentum or push to the upside. Now it's a little bit lower. That sets up this idea that maybe we've got a bit of a bearish divergence going on the broad market. What do you think?
Yeah, it's an interesting take on that, Ben. It does have that bearish divergence. And the RSI, typically speaking, when it goes into the overbought zone the first time, really doesn't have a lot of bearish emphasis with it. It's usually the second or even the third time that it goes up or near that overbought zone that it really becomes into a concern for technicians, right?
Yeah.
And so with this, it could show that there's a possibility that price is peaking out for now. And one thing we should always state, though, Ben, is that when you see something like a bearish divergence or bullish divergence or any sort of divergence in general, is that they don't necessarily mean change in trend, just possibly some, if it's a bearish divergence, maybe the run is on weary legs and it's ready to roll over and just take a breather for a bit, possibly fall back to a support level before it runs again. But I think what you're saying is very, very astute there, that yes, according to the RSI, it is showing some weakness in the overall movement.
And the fact is, I mean, we look at the trend, we look at the fact that year to date, the market is up 9.2%. Month to date, it's up a 1.75%. It's kind of sitting flat here for this week as we open up the week this week. But at the same time, there's this overall bullish bias, right? We know that the market generally likes to go up, and so that tends to counter some of these kind of short-term bearish, maybe where the market is falling off a little bit. There's some coasting higher. It's not being driven higher. And as we'll talk a little bit about what's going on over the course of this week, we're kind of at the tail end of earnings, so there's not as much of a push to the upside necessarily. There's not as much of a push to the downside, to be fair. But we're going into the Fed's summer convention, if you will, up in Jackson Hole, Wyoming, where they talk about a lot of things, and that's maybe what a lot of investors in the broad market are waiting for. Now, a little bit of a different scenario here this morning on the NASDAQ, if we rotate over here to the tech-heavy index, not quite as much of a sideways move in the last 4 days or so. Actually, in fact, pulling back a little bit into a support, isn't it, Brett?
Yeah, this one more of a bull flag type scenario where it's had a good run for a week or so, and over the last 3 days is starting to pull back a bit. And so possibly, it's going to be interesting, Ben, to see what happens today, because you can see the line that you've drawn in there creating a potential support area from that old high. And so we'll have to see if that does indeed hold or if it pulls back just a little bit further on that flag. But so it is at an inflection point.
Yeah, for sure. And could potentially create a bounce if it breaks below that level. Though you've got another couple of levels of support below this before really the trend even begins to change, maybe down here around the 22,722 mark, which is corresponding roughly with that still rising 50-period moving average, the 200-period moving average, the green line here, that longer perspective on trends still rising as well. And the NASDAQ itself up 11, almost 12% on the year so far, and a little bit stronger month to date. Now, where maybe the perspective of the Federal Reserve and interest rate changes and things maybe comes home to roost a little bit more, and where we have honestly seen, uncharacteristically, Brett, a little more volatility recently, just in the last week or two, is in the small cap index, the Russell 2000. What are your thoughts here?
Yeah, the Russell has been recently one of the stronger indices, right? Now, we've been talking about support and resistance, so we just mentioned on the Dow. The Russell's actually up against one as well at 2325-ish is a pretty good level of support going back to, resistance rather, going back to January. And this is actually a projection. I put out some tweets about this months ago, talking about some potential moves and where, like the Fibonacci would say, it could potentially find some resistance in the future. And actually, it's right up against that spot now. And so if, we've seen it pull back a few days for the last 2 days, 3 days. However, that's what you'd expect when it runs into a pretty solid resistance area, right? Is a pullback, find the support, and then make a run again. but it has been holding in there on the, on the overall move that it's
Absolutely.
had since April. Good grief.
Well, I just mentioned that we were in Chicago over the weekend. We were teaching technical analysis on Friday. We were teaching option strategies on Saturday. And anybody that's been in that workshop knows, as you have been at those workshops and participated and been up there on stage with me, we talk about a couple of different things. When price gets to a resistance level, the first expectation of many technicians and many traders is that price is going to hit that resistance and bounce down, much like throwing a ball up against the ceiling. We expect that price is going to bounce down. And the other thing is, it's always a good idea to look back left on the chart to confirm what's going on right. So I like the fact that you pointed out this previous resistance here at that 2325 area, because I just drew the line in. We go back into the January, February timeframe. We go back into the December timeframe, and it's acting as not only a support but also a resistance area in that time frame as well, and could be helping to create that little bit of a bear or a bull flag here. Possibility is we're not seeing a lot of movement today on the small caps, kind of staying where it is. So Brett, now that we look at kind of the broad cross section of the market, the SPX, the technology section of the market, the NASDAQ, and the small caps, which also contains quite a bit of financials, some of those stocks. We're going to look at sectors here in just a minute, but there are a couple of other areas that are maybe driving this market that it perhaps would be important to pay attention to. So I'm going to change my chart grid here to my single grid, and we're going to take a look really quick at oil and gold. I mean, that always seems to be kind of the glittering star of like some of those additional driving forces in the market. And I'm going to take implied volatility off of there, and I'm going to add that RSI back into this chart just so that we can kind of see, again, that momentum and sentiment perspective. So we'll grab RSI. You can see how easy it is to add indicators to the chart. And the thing I notice here about oil, Brett, is despite the fact that it's sitting at that 62, 63 level, it can still go lower, and it is going lower at the moment today. That futures contract, not using this as a tradable instrument. It's important to remember that. We're using this as a measure of what's going on in the market and the influence that oil has on a lot of other aspects of the market here, Brett.
Yeah, so as you mentioned, it's not necessarily it's been driving lower, and it's not at an area where you'd anticipate any bounce at the moment, right? According to technical analysis, that it has a little bit further possibility dropping down to maybe the 5750-ish area, where that would be like the more significant level of support. That'd be the next one up.
Yep. And I think, we look at coming out of the end of summer, right? If we think about some of the traditional influences on crude oil demand, one of those has been, retail gasoline sales, consumer driving demand. And we're coming out of a time where that has been high relatively. And so demand may be falling off as we get into the winter time. That demand generally is a little bit less. There's been concern about tariffs and that impact on kind of the manufacturing and industrial and shipping demand. And so maybe a little bit more weakness here to that crude oil price. We'll take a look at the energy sector in just a minute. The other area that I want to look at, go ahead, Brett.
I was going to say, we usually talk about back to school this time, but you and I have been doing this for so long that no longer is back to school, heading back over to the junior high, elementary, junior high, or high school. Now you're driving your kids halfway across the state to take them back to school in college,
which I am doing tomorrow. Exactly. Yes, that is exactly. It's the same kind of first day of school feelings. It's just a different location for sure. You and I had this conversation the other day, and boy, I gotta avoid blubbering here. But hey, looking at gold futures. Speaking of making gold out of something here, gold again back on the move a little bit here, perhaps giving a bit of a possibility of a bounce off of a support level. It's been pulling back a little bit as there's maybe been less of a safe haven concern. But Brett, I happen to notice this. I'm just going to draw the line along these levels here, that this again seems to be kind of climbing that level of support and rallying a little bit higher here.
Yeah, that's exactly where I drew a line on my charts, on my own thinkorswim platform. And so it's sitting right there back at that support level. Some of the indicators have dropped down, nothing major, but starting to slow down. Like I have a MACD on mine, and it's starting to slow
Yep.
down in the decline, right? Meaning that the bearish momentum has waned. And when you see that bearish momentum waning as it approaches a support level, from a technical analysis standpoint, look to see if watch for potential bounce off that support. It hasn't happened yet, but that'd be, from a technician standpoint, the obvious thought.
Right. Now, I will tell you this. I mean, we've been kind of dancing around this idea of the Federal Reserve, right? So let's maybe talk just a bit about it. And I think this is probably as good an indicator to be on when we talk about the Federal Reserve as any, because one of the reasons why gold has made the move that it has, and again, we don't know all of the reasons why gold has been as strong as it has been, is the concern about inflation. Gold as a safe haven from those inflationary pressures. We've seen changes to the US dollar and pressures on the US dollar. And a lot of that comes from the actions of the Federal Reserve, especially around interest rates. So here we are, Brett. We've got interest rates that are not enormously high, but they are still relatively high if we put them in the context of the zero interest rate policies coming out of the Great Recession, right?
But is that really a fair comparison? I'd like what you're saying here,
I don't
Ben.
know if it is.
0%, is usually, for most of our lifetime, it wasn't at 0%, right? I mean,
right.
I think when I bought my first home, it was at 9%. And my parents were saying, boy, you got a steal of a deal, because they paid 18% for their home. And so they thought I was shouldn't be complaining about my 9%. And so it's just really interesting as we go into, there's just so much chatter out there, Ben, about what's going on with the Fed, and the Fed should be lowering interest rates, and I think it goes back to what you were just saying about there's concern, right? I mean, there's a talk about the tariffs and things, and that leads to that uncertainty. And the uncertainty is something where investors are a little bit hesitant. However, there's a lot of FOMO out there as well. And so they still see stocks climbing. And so they possibly want to, get in and not miss that. But I mean, just talking basic economics, you still have unemployment is under 5%. It's what, 4.1%, 4.2%?
Correct.
It's still low. And yet inflation is still higher than the Fed typically looks for. Right, sitting at depending on what you're looking at, the PCE and stuff, it's still above 2%. Right. It's closer to 3% and stuff. In that scenario, they would not cut rates.
But there is a lot of pressure, and so this, I think, really is a good test. Will the Fed succumb to political pressure? Are there pressures that are suggesting that that interest rates could be cut? Yeah, absolutely. I mean, we're seeing some slowdowns in some areas, so. On the other hand, you make a very good point, Brett. And I think the fact that, we've seen interest rates, I switched over here to /10Y, which is the futures contract. Again, not using this as a tradable instrument, just as a measure of the 10-year yield, that 10-year rate, which is the metric that's used for a lot of auto loans, for home loans, which we're going to talk about housing here in a second. And you can see how it's kind of been static, but I wanted to put this into a longer context, Brett. Let's pop this out to a 3-year weekly chart. And you can see we've been stuck in this range for quite some time, but it has been declining a little bit. It's still it's maybe squeezing, right? We're kind of seeing this rate squeezing into this 4.4, between 4.2 and 4.4, maybe 4.6 on the upside. So I guess I ask the question at this point, what would a declining rate, what would a cut to the rate, which comes on the front end of the curve on the part of the Fed and then trickles through to these longer term rates, what would that do to the market? So I'll let you talk about that while I put an overlay of the SPX on top of this particular chart.
Well, the answer is no one exactly knows. The typical reaction, though, is the market tends to like lower rates, right? So you would see an increase in the market with lower rates. It's interesting, Ben. I want to go back on just one thing you said here, though. It's like you have seen the rates climb, and I think that's an important point where I was just mentioning that rates, for me, as I think longer term, these are pretty good rates, but we often have a short-term memory, and therefore most people look at this and say, wow, rates are high because they are relative to what they were 3-4 years ago, right? And so
we tend to anchor to recency, right?
Right, exactly. And so those things all need to be taken into consideration on how the public will respond, as those rates come out and whatever the Fed does down the road. But generally speaking, when the Fed does lower rates, then you tend to see a pop in the market, generally speaking.
Absolutely. So this is kind of a longer term perspective. Again, this is the 10-year interest rate futures contract on a weekly chart compared to the S&P 500. And you can see that there is some kind of oppositional correlation here where when those rates have risen significantly, the market was moving down. And then when those rates started to come down, but all too often, Brett, it certainly seems as if it was the market that was leading rates as opposed to the other way around. And so I think you talk about the influences, the interest rate is simply one factor in what the market does and how the market behaves. It is not the only input nor the only factor that dictates how the market moves, right?
Yeah, and in fact, I remember back in the 2000s, Fed would raise the rate a quarter point every time, another quarter point, another quarter point, another quarter point, and yet the market continued to go up because while rates were rising, people were looking at that was the housing boom, right? And everyone was just like enjoying this their equity increasing, right? And so they're cashing out and spending, and so the market stayed strong despite raising rates. And so just like you said, Ben, there's a lot more variables than just is it the rate going up or down?
Absolutely. So I wanted to pivot a little bit here, Brett, to the VIX before we get into some sectors and individual stocks and start talking about the different components of the market, because this is the volatility index of the market. This is suggestive of, I think maybe, we used to call this a fear and greed gauge, but I think, it's becoming perhaps a little bit more of a sensitivity gauge. How sensitive is the market to all of the forces that are swirling around out there? And when there's a lot of fear in the market, when there's a lot of potential for market movement, we can see big hairy spikes in the VIX. Volatility goes up, institutional investors buy protective products, and they're willing to spend a lot to buy that protection against downside movement. Right now, though, the VIX, as is typical in the summer, but maybe even a little bit more so this summer than last summer, the VIX has been grinding back down into that 14 handle. It's now come up a little bit today. It's in the mid 15s, but it's not spiking, and it's not spiking necessarily on fear. In fact, it may be spiking a little bit here on speculation of the market moving higher, because what we have right now is the SPX up and the VIX up a little bit, which is becoming more and more an occurrence that used to be very, very rare, right?
Yeah, and then overall, I mean, the VIX is really low, right?
Yeah.
Generally speaking, the VIX is extremely low, so we can get some oscillation down at that low area. And even when we have these earnings announcements, we mentioned Home Depot coming up is you got some big names having earnings announcements, some things like that in the Jackson Hole. There's always these things out there that create some concern, a little bit of anxiety. I mean, there's Trump and Zelensky and Russia and all that stuff going on at the same time. And so there'll always be some sort of vibration in the market that will cause some momentary spikes, up and down a little bit. But generally speaking, the VIX staying low. It has been, hovering just above the 14, 15 area for a while. And, I think it's where it becomes indicative of the market just kind of drifting higher. Maybe not pushing forward, running higher, but drifting higher.
And that's consistent with what we talked about with that SPX or the SPX and looking at the relative strength indexes, that we were really kind of getting that drifting. So, Brett, what I want to do now is I want to shift over here really quickly because I want to get to a couple of individual stocks. And so I want to pop over here to a grid that I have that I use oftentimes in my Friday webcast, which is when I'm in town. I teach the Market Movers webcast on Friday afternoons. It closes out the week, it closes out the day, but I want to look at the S&P 500 sectors, and I kind of want to go through these individually really quickly and just get a sense of what is going on in terms of each one of the sectors of the market. So let's take a look at energy. And not surprisingly, energy down a little bit. We see that on the right-hand side of the chart, a little bit of a gap down into a hammer candle this morning. That's consistent with that crude oil number falling here. As goes crude, so oftentimes does the energy sector, but not entirely. It is the big driver there. Materials largely moves concurrent with energy too, because a lot of the building materials and a lot of the companies that fall within materials depend on petroleum products for those materials. But this is one that's interesting. Industrials is kind of holding up here a little bit, but perhaps sitting on a bit of a support level, Brett.
Yeah, holding. We got what is the 50-period moving average in there?
Correct.
If the 30-period were in there, it might be even sitting right at that 30-period moving average, right? And not that you should change the moving average to match the chart, but I'm just saying there could be some potential other areas that some stocks or indices or whatever the chart is may drift to a little bit more closely than others. Either way, that sideways action is just holding support right there on the indices. What it was on the industrials.
Yeah. Now, let's pivot over here to consumer discretionary, which has been pretty strong in the last couple of weeks, maybe on the backs of back to school spending, those types of things. But, it's really interesting that we're seeing this little bit of a pullback, but that has been where there has been some strength relative to consumer staples. So, we typically will look at a market and say, are staples moving higher or are discretionaries moving higher as kind of that risk on, risk off type of scenario. And it would certainly seem that if we were to compare these two side to side, discretionary has been the stronger of the two. And so indicative of that risk on market, Brett.
Let's kind of, people will say what they want to say, but the action really tells the tale, right?
Yes, it does.
When they're willing to open their wallets and go back to school shopping or whatever shopping, that still indicates what their overall sentiment is.
Now, I wanted to look at one stock here relative to consumer staples. So I'm going to put a pin in this really quickly in terms of consumer staples, and that is J&J. So we'll come back to J&J in just a second. Let's rotate through the rest of these. Here's healthcare. Healthcare has seen a pop to the upside. One of the stronger areas, but maybe running into a little bit of a resistance level there. Now, we'll also talk a little bit about what's going on in the pharmaceutical space, which gets wrapped into healthcare. But I'm also interested in financials, which have been moving down a little bit as we get to the tail end of earnings season. And then here's where I think a lot of people are really focused in terms of their attention, at least in terms of the stocks that they're buying, and that is in information technology and communication services. And these have been the stronger of the two areas. You can see how this has mimicked a number of those stocks that are in this space. Infotech and communication services, you look at those back to back, and I can just kind of flip back and forth, and there's just not a lot of difference between those two, is there, Brett?
No, they've both been some of the stronger, leading sectors out there. And by the way, Ben, I just want to just jump in real quick and kind of take us back for a moment to another conversation. There's a lot of chat in the comments that are talking about the housing prices and stuff. And hey, my mom bought a house at 17%. Mine was 13% and stuff. They also mentioned that the prices were quite a bit different as well back then.
And prices as a percentage of earnings too, right?
Correct. And so the interest rates are playing a much bigger role in the overall, ability to buy a home now than they were back then, because the prices are so much higher, right? I mean, it's still 4% or 3% or 5%, whatever, but it just is more difficult to stomach. It's 600,000 versus 33,000, right?
Sure, it is. Even though, I mean, I think you talk about it in terms of relative percentage. Back then, those rates and those prices were a smaller chunk of what people earned. And I think that's one of the reasons why I've landed right here on the real estate sector. And that's why we're seeing this maybe being one of the weaker performers in the S&P 500, although perhaps not the weakest performer. We could probably look at healthcare overall as that, but real estate still just kind of stuck in a sideways mode, don't you think?
Well, just talking to people myself, I hear a lot of people saying, I'm waiting for rates to drop, something along those lines before they look to purchase a house, or we need to save up a little bit more, or just, just too much right now, too expensive right now. And so you get a lot of varying reasons, but still a lot of people on the sidelines. And you can't blame them if there is this idea that rates are going to drop. Why would you lock yourself into a very expensive mortgage, or a more expensive mortgage, right? Only to turn around in maybe 6 months or a year and look to refinance that.
And it is that exact idea that you just vocalized, Brett, that idea of we'll wait and see, that makes things like disinflationary pressures or deflation such a challenge for the market. Because if there is an expectation that prices are going to be less tomorrow, right, or that rates are going to be less tomorrow because of something happening, there's always that wait and see mode, right? And so traders, investors, consumers wait for those cheaper prices or wait for those lower rates. So again, this is always kind of that waiting on what's gonna happen that's impacting the real estate market.
And one comment came in saying it, but where was it? Builders are strong, and there still can be a separation in that between the builders and stuff. I mean, when you have prices go up, there can be the opportunity for more profit potential in there, right?
Sure.
When like Walmart's trying to squeeze just pennies off of what they sell, type thing, or your gas station, similar thing. But when prices get very expensive, it becomes more flexibility for profit potential in there. And so you can see some that still remain lean and perform well, or build well, they have a good organization, still continue to turn profits even when prices are going up. You think, well, okay, how much more can they go? And people are slowing down. Yes, but when you get more profit out of whatever you're creating, then your bottom line can still look solid.
Absolutely. So a couple of questions out there in the chat, Brett, that I wanted to address right now before we get into individual stocks, because I think it's a good time for us to talk about this idea. And F. Young asking the question, how do we qualify to trade options? How do we trade options? A number of people may be brand new to trading in general and coming into this broadcast this morning and saying, hey, what are the resources that are available to me at Schwab to learn more about trading? And so I wanted to show a couple of those quick resources here, Brett. And I think these are important. So I'm landing on here, schwab.com/coaching. This is the landing page for Schwab Coaching, which is where you and I do the work that we do. And I wanted to show a couple of things. The first thing I wanted to show is right here, this link that says live webcasts and virtual workshops. And I wanted to show the calendar view of the live webcasts that we teach. And we teach 30 some odd hours, 30 plus hours of live webcasts throughout the week. We record all but 2 of those hours, and those 2 focus on exchange traded funds where regulatory issues keep us from recording those. But you can go through the day and you can see all of the webcasts that are being taught for that day. So coming up later today, in fact, coming up after this webcast, we've got, if you're just getting started, our good friend Scott Thompson teaches a webcast series called Stock Investing for Beginners. So if you're just getting started, that's a great place to go to get started with this discussion. If you're learning how to trade with a smaller account, the Trading a Smaller Account webcast is a great place to land. Trading with technical indicators helps to understand technical analysis. Trading covered calls and short puts gets into some of those option strategies. And then we've got others. Now, this is the one that I wanted to point out to specifically address F. Young's question, how do you get started trading options? This one right here, Getting Started with Options, is a playlist and a series of webcasts that breaks down the basics of trading options. It's a great place to get started. We've got trading futures, we've got trading index options, we've got a lot of great webcast content. And then the other thing is, Brett, you can come over here, and I know you put this post together, which is great. This is kind of a general overview of all of the different webcasts that happen throughout the week, who's teaching them. You can see the faces and the personalities and everything that you can hear. And you can get a sense of what's going on throughout the week, Brett.
Yeah, I wanted to get something out there with your beautiful faces on there. I think
Yeah, perfect.
this not only shows it, but it makes it really easy to see what we teach on a weekly basis. So I appreciate you sharing that, Ben.
Absolutely. Hey, now this isn't the only place that you can find our content, is it? Right? We can find it here on the webcast page on YouTube. But you mentioned it earlier, Brett, and that is X, the social media site. You post over there on X. Your X handle is at Brett Crowther CS. Mine is at Ben Watson CS. All of the other coaches have a similar naming convention, so you can find us there. If we're not doing a webcast or we're not teaching a live workshop, we're posting on X. We're getting content out there. We've got short form content. We've got videos that are going on out there. It's some great, great stuff for you to participate in the conversation, right?
Yeah, it's a great way to connect in between each week, right? We hit webcasts, or I'm not frequently on a webcast, and so I'm glad to be on here. And so it's my way of reaching out and expressing what's going on in the market. But it's a great way for all the coaches as well to continue to connect with people.
Yeah. And while we're here on Trader Talks webcast, click on subscribe, just like we asked you to before. It's at no cost to you. It's a great way to stay connected by following us, and it helps to bring that content there. So let's pop back over here, Brett. Now that we
as you do that, I just see some comments. Barb Armstrong has been out for a while with some health issues, but she is back. She's back in the office today. For those, I see a lot of comments about that, and hopefully she'll be back teaching some webcasts this week.
For sure. So this is the one that I wanted to bring up. Remember, we were talking about the consumer discretionary space being relatively strong and the consumer staples space. Johnson & Johnson, J&J is the symbol, they fall squarely in that consumer staples space. And what I've noticed on this trade, or on this stock right now, is this little bit of a break above. I'm going to zoom in over here on the right-hand side, and I'm going to kind of bring this down a little bit. But there are two things that are going on that I notice here. One, the stock has broken out above a resistance level, and two, that RSI is really continuing to show momentum pushing to the upside. So one of the things that a lot of traders struggle with, Brett, as you know, is the mental mindset of saying, well, I can only buy low and then sell high, but then they never sell high, and they buy low and they hold on to stocks until those stocks go lower. So maybe one way to kind of resolve that is buying high and looking to sell even higher, right?
Yeah. Well, yeah, it's funny how I think a lot of people have, not a lot of people, but some people have the buy low, sell lower concept down, but it's more difficult to flip it around and go buy high, sell higher, right? Now, one comment that might come up on this, Ben, is you bring this up. I'm glad you mentioned that whole buying into the strength kind of concept. Some might look at the RSI and say, hey, but you started the program talking about the RSIs in this overbought zone and stuff.
Yeah.
However, that was looking at a divergence. It was actually showing weakening on the RSI. This one is not showing that.
Yep, you're right. So what we're going to do is I'm going to just put together a quick trade here, Brett. And again, this is an illustrative example, not a recommendation by any sense, but we've got some strength going on today. So I'm going to create an order to buy this stock in my paper trading account, and I'm going to put a stop order in here. So I'm just going to come in here to the chart, and I'm going to right click and buy custom with stop. Now, putting a stop order on a stock trade doesn't guarantee the price at which that order is going to get filled. It just lets us specify the price at which that order is going to be triggered, and then it'll fill at the next available price, or we could create a stop limit order. So just be aware of those characteristics of a stop order. So the stock's currently trading at 177.02 and moving around a little bit. I'm going to change this limit order because I want to get into the trade here. I'm going to move this limit order up and say I'm going to be willing to trade this stock at 177. I'll give it 25 cents above that, 177.25. And that limit order says buy it at that price or better. So as long as the price is below 177.25, that's okay. And then I'm going to come down to that level of support that we drew in here, right around 174. And I'm going to go a little bit below that. In fact, I'm going to come down here to right about 173. And I'm going to put this stop order in at a little bit different number. I'm going to go 173.23. I'm just going to do a little bit different number so that it's not falling right at a round number, 173, just rounding off. Traders tend to be a little bit lazy, and market makers know that. And so oftentimes they will put orders in at those even numbers or round numbers, and that may pick off a lot of traders. And I'm going to make that good till canceled. So that's not going to be something that we have to recreate every time. And Brett, we're going to just double check this and click on confirm and send, read through this order, make sure that this is an order that we want to place, buy 100 shares of Johnson & Johnson. And then we've got our stop order in there. We're going to make sure of all our transaction costs and that there are no alerts that we need to be aware of. And we'll go ahead and fire that order off and see if we get filled. And we did at 177.09. So there we go. So now we're in that order. We can see where our stop order is, and no guarantees that this is going to continue to move higher. But we've defined our risk in the trade by that stop loss, and we've allowed ourselves the opportunity to continue to move higher here. Right, Brett?
Yes, and then Ben, there's a comment in there asking, hey, what about a stop order? Is that just a $3 default? And I don't think that was not your thought process of just going a $3 default. You were looking for, in fact, go ahead and explain to them what you were thinking
for sure.
on that.
So I found that support level, and oftentimes, we might use that to help us define our decision to get out of a trade. If support is broken, then exit the trade. And I was giving it a little bit of flexibility because we know that levels of support and resistance aren't drawn with fine line pens on the chart. We paint them with big fat magic markers. And so giving that stop a little bit of flexibility allows for the price to come down and maybe bleed through that support level and then continue to bounce. But if it clearly breaks through that support level, then we're going to want to get out of the trade in this particular instance. That's what technical analysis would suggest, and that's how we set this example trade up. Not as a recommendation, and you can put your stop wherever you want, but that's how some traders may create stops. And I know, Brett, you talked a lot about this in your tweets. Scott Thompson talks a lot about this in his webcast, which is coming up after this one, about this methodology of protecting trades as that price is continuing to move higher.
Well, it's also being able to do some money risk management, right? Determining how many shares you should buy. There's a lot of things that can play a role into that we don't have time or nor is it a topic in this class to get into. But I appreciate you bringing that up, Ben, because it always is an important topic to discuss.
Yeah, absolutely. So I know I also put a pin in the pharmaceutical space. We were talking about healthcare. You see Novo Nordisk popping up today after the earnings announcement on the news that their Wegovy product was approved to treat a liver disease. And that's also impacting Lilly, which is interesting because Lilly got a downgrade. They're up a little bit more today. I wanted, though, to look, Brett, I know we had mentioned this really quickly in the housing space, and that was Home Depot. Home Depot has an earnings announcement coming up tomorrow morning before market open, and it seems to be kind of sitting back down on that little bit of a support level here, possibly with a bit of a bull flag scenario setting itself up. I know we've got a number of webcasts in our webcast group that talk about flag patterns, price patterns, bounces and breakouts. So something perhaps to keep an eye on as that setup begins to materialize ahead of this earnings announcement. All right. Oh, did we lose Brett's audio?
No, I'm still.
Okay, no, you're still there. Okay, cool. All right, so let's do this. I know we're just about out of time here. We're coming up against our time frame. So I wanted to give people, Brett, really quickly, because I know we talked a lot about some of the things that are happening this week. I wanted to come over here to the Market Watch tab, and I wanted to change our Market Watch tab from the quotes, which is how we get our watch lists, to one of the ways that we can look at watch lists, to this right here where it says calendar. And now, looking over the horizon, what we can do is we can see, let's see if we can get to all of those. Actually, let's go to current accounts, and we'll go to a watch list. Let's go to recent watch list. You know what I'm going to do? I'm going to go here to personal. We're going to select the watch list, and we're going to select the S&P 500, just so that we can see all of those stocks within the S&P 500 that might have those earnings announcements coming up. And as we look over the horizon, we can kind of go through each one of these weeks and see what's going on. We'll look at the weekly calendar. We'll see the not only earnings announcements, but we can also see some of those news announcements that are coming up. You can set up this calendar so that you can see, say, for instance, those Econo Day events like we talked about CPI. You can also see things like dividend payments. So this is a great way to kind of visualize what's going on throughout the week, Brett, and kind of a great way to get started, along with the things that we talked about right over here on the webcast page and on Schwab Coaching. This is hopefully everybody's now got a good start to their week and a good plan in mind of what they're going to be paying attention to, what they're going to be listening to, and who they're going to be learning from, right, Brett?
That's right. And, it's always good to start the week looking at, what could potentially shake up the market. It is a little bit, besides maybe the FOMC minutes and stuff, there's not a ton of major news announcements, but it's always good to be on top of, hey, what are the potential hiccups that could come along?
Well, I'll tell you what, there were no hiccups this morning, Brett, with having you on here, and it is always good to have you with us in this webcast. I'm glad that we had the opportunity to do this together. Once again, my thanks to Michael Fairborn for helping out. My thanks, of course, to Brett Crowther for being here. And most importantly, my thanks to all of you for joining us, whether you're joining us live or in the recorded version. Our great production staff is helping out as well, and our reviewers. We appreciate all of the efforts to help bring all of this content to you. Lots of great webcasts today, lots of great webcasts throughout the week. We will see you again very soon. Best of trading. Take care, everybody. Bye-bye.